Hi folks, and welcome to the Meaningful Money Podcast. This is Season 17, Episode 5. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we are once again. Great to have you with me. Thank you for joining me. Yet another at-home Meaningful Money podcast. It's just normal now, isn't it? Hope you're doing well, though. Now, risk is an inherent part of wealth building and wealth enjoying, as we're talking about in this season. And as you know by now, risk comes in all kinds of flavors, and some of which are specific to different life stages. Today, I want to talk you through the risks that you'll face with your money in retirement. That's where we're going today, risks in retirement. As usual, after the main body of the show, I'll look at a review that's been left, quick announcement about Meaningful Academy, the founders launch of the next phase. But before any of that, as ever, remember this podcast continues to be brought to you with the help of my friends at 7 Investment Management. They've been helping me out here since the spring of 2011. Literally could not have built this without them. So thank you to them. Please do check out what they're up to. They're at 7im.co.uk. That's the number 7im.co.uk. Go check them out and say thank you. Okay, so risk is a horrible word, right? It's just 4 letters, but it covers a huge amount of detail and it triggers quite an array of emotions as well, many of them negative. Now, experienced wealth builders have come to associate risk with reward when it comes to investing, but for those who are in retirement, while that's still true to a point, the potential downsides of taking risks can loom larger. So rather than breaking today's show into what you need to know and what you need to do, I'm going to be looking at the key risks in turn. There's only 4 of them, and looking at some action points to take after each one. Remember, as ever, notes and links from today's show are at the show notes. It's the only link you need to remember. So if you're, on your walk or, cutting the grass or doing whatever, listening to this, you don't have to write it down. Just remember this, only one link, meaningfulmoney.tv/RP5 for retirement planning. Episode 5, meaningfulmoney.tv/RP5. Let's have a look at some key risks in retirement. Okay, number 1 is sequencing risk. Sequencing risk. Now, I'm guessing that by the time you've got to the point of retiring, you've become aware of the fact that investments rise and fall, right? That's as much part of the investing experience as tomatoes are to a bolognese sauce, right? It's like integral. It's not a bolognese without tomatoes. Investing isn't investing without an element of risk. So it's impossible to build wealth without some degree of investment risk. It just comes with the territory. Now, back in days of yore, when I became a financial advisor, it was very common still for retirees to buy annuities with their accumulated pension pots. The best and most succinct way, I think, to describe what an annuity is it's a guaranteed income for life. The guaranteed nature of it is a key part of the attraction of annuities. Unfortunately, rates have reduced so much over time that they rarely look attractive to most people these days, and the pensions freedoms of 2015 were another major factor in the decline of the popularity of annuities. Now, the default view of retirement is that we want to start enjoying the money that we've been salting away all of our working life. And an annuity was a way to do that, to sort of finally take the foot off the gas, convert your fund that you'd been building over so many years into an income and just forget about it, really, because it was guaranteed. It would come in every month, every year. You could enjoy the fruits of your labor with not a lot of thinking or worrying about your income. These days, far more people enter some kind of flexible drawdown arrangement than buy annuities. The desire to enjoy the money is the same, but the mechanics are vastly different, simply because the money remains invested. Because of that, you have to remain engaged to a greater degree, greater or lesser extent, but certainly greater than you would with an annuity. You have to remain engaged with your pension pot and the way it is invested. And as we've said, with investment comes risk. And that's just as true in retirement, of course, as it is in the accumulation phase. But now that investment risk takes a slightly different form, because it isn't so much the fact that markets and hence your investment value will rise and fall. It's more the timing of the rises and the falls in relation to your need for income that matters. Now, sequencing risk is defined, in many different ways by many different people, but my standard definition of it is it's the risk that you need to make a withdrawal from your investments when they are already depressed due to market conditions. Right? It's the risk that you might need to make a withdrawal when your investments are suffering, shall we say. So really, it's the combination of the timing of your withdrawals, which you can control to a point, and the timing of market cycles, which you cannot control. If too many of your withdrawals happen at inopportune times as far as your investments are concerned, then there's a good chance you'll do significant damage to the longevity of your portfolio. So if it were possible in an ideal world to only draw from our investments when they're showing a profit, that'd just be great. Now, we know that if we could do that, we would never ever run out of money. But more practically though, most folks take some kind of regular income from their portfolio, or they don't hold enough cash so that they then need to draw from their invested monies for ad hoc, perhaps unforeseen expenses. And Sod's Law says those things will always come along at the worst time. So, what can you do about this sequencing risk, this inopportune phasing of you needing to take retirement income with unfortunate timing when it comes to markets? Well, if you haven't already, listen back to my conversation from last week with Matthew Yates of 7IM, my sponsors, because he was describing how they have built their retirement income service, which is designed essentially to minimize the impact of those withdrawals happening at the wrong times. We do something similar for our clients at Jackson's Wealth. I call it the cash flow ladder, and I'll explain it for you quickly here. You should definitely listen back to episode 8 of season 16, where I go into a little bit more detail. There's a link in the show notes to that as well. So your starting point should be your baseline attitude to investment risk. So I suggest that you download an app called Beam. If you're on an iPhone, it's available now. It should be out fairly soon for Android and web users. Beam will give you a real insight not only into your risk profile, but also your behavioral tendencies, a little bit more of which later. For the purposes of this quickish description, let's say that you come out as a balanced investor. So the idea of the cash flow ladder is that you assess your regular spending needs month to month. So, how much does your lifestyle cost you? Let's say that it's £2,500 a month or £30,000 per year. Well, ideally, you want to keep twice that figure on deposit in the bank or in a cash holding within your investments. So in this example, that's £60,000. Now, that might seem an insane amount of money to keep in the bank with interest rates as low as they are, but if you think of it as a buffer against you losing money on the invested portion of your portfolio, then it'll ease the angst a little bit. In practice, though, it probably won't be quite so much as that, because chances are you'll have at least some secured sources of income, not least the state pension, or maybe pensions from other sources, defined benefit schemes or whatever, maybe rent from buy-to-let properties if that's your thing. If these income sources are largely guaranteed, then it's the difference between those and your annual expenditure that you should use for your 2-year cash buffer calculation. You should also try and factor in any large ad hoc expenditure you're likely to make in the next year or so. So if you've got a big holiday planned before COVID put the kibosh on all that, or maybe you need to change the car, it's worth having the cash on hand for that as well. Again, the whole point is that you don't have to fall foul of sequencing risk. You keep it in cash and don't invest that money. This is already turning out to be a longer explanation than I intended. Never mind. So once you've got like the next 2 years worth of expenditure in cash, you should keep another 3 years of expenditure requirements in investments which are maybe a notch or two down from your standard risk appetite. So they can be invested. But if you're a balanced investor, say in this example, you could invest that money for the sort of years 3, 4, and 5 in perhaps a moderately cautious approach. Then for years 5 to 10, you should invest roughly according to your risk profile, so balanced in this case. And after that, for money you're unlikely to need to access for at least 10 years, you could even consider investing a notch or two above your risk profile, figuring that time will help to smooth the higher volatility in that money. And the idea is that money moves down the ladder each year nearer to you. You're at the bottom of the ladder, right? You need it at the bottom of the ladder to spend. And each year you should assess your income needs for the coming year, plus the state of the market and your investments. If you're in profit, then maybe you can top up your cash at the bottom of the ladder. If not, then you can delay doing that for up to another year, because we've got up to 2 years in cash, remember, because that will then give the invested portion time to recover. It's not quite as simple as just topping up the cash portion from the moderately cautious pot. You will need to consider the makeup of the whole lot and redistribute accordingly, rebalance. There's quite a lot of variables here, which, if you listen back to my conversation with Matthew Yates, you'll gather that there's an awful lot of calculation that goes behind what they are doing. So, hopefully you get the general idea of the cash flow ladder. It is worth mentioning, by the way, that I'll be addressing this in much more detail, assigning an entire module of learning to it in the retirement planning phase of Meaningful Academy. That's phase 3 of the Academy. We're going to be doing a founders launch for that very soon, in the next few weeks. So more detail on that at the end of the show. So sequencing risk is a big deal, but it can be mitigated to some extent by cash flow management. I haven't even touched on the other variables under your control, which is particularly the main one is your spending choices. If you've had a particularly bad year in your portfolio, perhaps you can ease the impact of sequencing risk by actually dialing back your spending for a time, spending a little bit less, or maybe not increasing your spending by inflation. If you haven't already, read the best book on this whole subject. It's called Beyond the 4% Rule by my good friend and previous guest on the show, Abraham Okosanya. There's a link to that book in the show notes. So that's sequencing risk. It's a big deal, and we need to take account of it in our investment planning. Next up, though, is inflation risk. Right, that's about 1,300 words for that first point, so I need to try and pick things up a little bit. Now, inflation is something that we don't really think about too much when we're working, and that's because, for the most part, earnings rise in excess of inflation. So we get a little bit better off each year. If your income generally rises more than things get a bit more expensive, you're going to be able to buy a little bit more next year than you do this year. Now, I know that's a massive generalization, okay? If you're shouting at your car stereo because your personal experience is that your earnings have not risen in advance of inflation, I do understand, right? It's a generalization. But for all of us, really, inflation is a much bigger deal in retirement because, generally speaking, our income, other than the state pension and maybe any defined benefit schemes that we've got, our income might not be set to rise with inflation. Also, a greater proportion of our expenditure tends to be made up of things which rise in cost at a slightly greater rate than the general rate of inflation. Things like food, fuel, leisure spending. If we're drawing an income, i.e. we're making withdrawals from our portfolio, then obviously that will need to rise each year. And in turn, that means that we'll need to invest a little bit more aggressively to make sure we're getting super inflationary growth, ideally. Or at least we're going to need to accept that we're going to erode our capital, and we just need to make sure that it doesn't erode too quickly and run out before we shuffle off. So if inflation is a bigger factor in retirement, what can we do about it? Well, the investment approach is a big factor. Okay, we need not to be afraid of investing properly, investing perhaps even somewhat aggressively, especially towards the top of the cash flow ladder. When we come to rebalance our portfolio, we need to be careful to try and do so thoughtfully rather than just a sort of blanket rebalance to how we started. Usually, the default option would be to top up our cash reserves from the bond or fixed interest portion of our portfolio, which would leave the equities intact. But that still requires us to have a mind to the overall balance. We won't want to end up sort of too equity heavy because that will change the risk profile of the whole thing. Essentially, it's a question of reviewing things intentionally. We obviously can't do anything about inflation itself, right? As with all these things, I think half the battle is about being prepared for them by thinking about the impact ahead of time. So when I'm planning for clients using the cash flow modeling tools that we use at Jackson's, which incidentally are available within Meaningful Academy as well, we always factor in that all costs will rise by inflation. We then use conservative estimates for variables like investment growth to try and build in some conservatism when they're planning. Last thing we want is to overestimate stuff and then be disappointed, or even worse, suggest that our clients, yes, you can retire, no problem, when maybe actually they need to work a couple more years to really build in some fat into things. Now, it might be that you've never really thought about inflation like this. I do wonder sometimes when I read the comments in the FIRE Facebook groups and things like that. Those guys are so enamored of the 4% rule, which of course isn't a rule, it's a rule of thumb. I do wonder whether they've really factored inflation into all that. It's all very well having 25 times your annual expenditure in liquid assets, but if your annual expenditure is going to double every 20 years due to inflation, you've got to factor that in, right? Countering that, of course, is that the evidence says that on average spending actually reduces over time in retirement, real spending. So, planning helps to mitigate the impact of inflation. There just would be nothing worse than planning for a long retirement, but vastly underestimating your expenditure over that time, and the whole thing just falling apart because you haven't invested properly and you haven't planned properly. Number 3 is longevity risk. Now, this is essentially the risk of living too long, right? How can you live too long? Well, I mean, living too long in relation to your money. So I don't know can you imagine running out of money in, say, your late 70s because you've spent too much early on in retirement? I mean, my mum and dad are in their late 70s. Imagine them, going from the lifestyle that they've had to just state pensions only, right? You could kiss goodbye to holidays, changing the car. A big expense comes on you, like a boiler blowing up and you have to replace it. That would be hugely problematic. Now, I know that's unlikely to be the case for folks listening to this because you're engaged with your personal finances, you have good plans, you have intelligent investment approaches in place. But one thing I've noticed in my career is that most people significantly underestimate their longevity. Now, of course, none of us actually know how long we might have, right? But whenever I tell a client in the financial process that we are, financial planning process rather, that we're planning for them both to live till age 100, they'll usually say, oh, I hope I'm gone before then, or that's unlikely, I drink far too much wine to live till I'm age 100. But if you plan to spend your last penny by age 85, that's just madness. I mean, if you're in a couple, the odds are round about even, if you're 65 and in a couple, that one of you will live to age 90 and beyond. So, you don't really want to plan to 85. Now, I'm certainly not suggesting that you take up smoking and blindfolded jaywalking or something to make sure that you don't make it past age 80 or 85. Life is obviously worth living and enjoying every day that we're given. So this is really about making your money match your lifespan, not the other way around. And again, planning, I think, is the answer. So if we factor in longevity assumptions into our planning, we're unlikely to base our spending patterns on too conservative assumptions about how long we're going to live. We need to plan to live longer so we can work our spending patterns and hence our investment approach into that. You're probably getting the idea. Planning is really everything here. Finally, the final risk I think that we need to mention is behavioral risk. Now, regular listeners are probably rolling their eyes, saying you won't be surprised to hear me talk about behavior. Now, I define behavior risk as the risk of you doing something stupid with your money. So forgive the bluntness, but this is actually, I think, the number one risk for all investors, no matter what time of life you're in. So here's an example, right? 2 investors hold identical funds in identical amounts. Because they are identical, their 2 portfolios go up and down perfectly in sync. But one investor, when markets are down, sells out for a little bit to let things settle down and inevitably buys back into the fund when they are significantly higher than the bottom of the most recent dip. The investor who buys and holds retires probably with twice, maybe even 3 times that of the investor that tries to time the market. They hold identical funds, but the differentiating factor was their behavior. And as I said, essentially all risks come down to this. This is a key point, right? So listen up, folks. Risks are never abstract. They don't happen in isolation. All risks are essentially triggers or potential triggers for investor behavior. And it's that makes the real difference. So investment risk, the ups and downs of your portfolio might make you panic about your investments and sell out, to try and limit any future losses. Well, what you've done then, of course, is you've crystallized the loss, and you are the cause of that loss now, not the markets. Inflation risk might make you underestimate the return that you need on your investments, and you might not invest aggressively enough to keep up. Well, that's not the fault of the investment, but the investor. It's a behavioral issue. Longevity risk might make you underestimate your longevity and invest, accordingly. And again, it's behavior that's the issue. It's not the makeup of the portfolio. That just springs from the behavior. And a massive part of the reason I do what I do here is to try and arm you with sufficient information so that you can guard against these behaviors even if you're not fully aware of them in yourself, that's not a failing, by the way. It's incredibly difficult to see behavioral biases and tendencies in ourselves. Much easier to notice them in others. That's why a good advisor who is attuned to this stuff can really be worth their weight. Now, again, download the Beam app. There's a link in the show notes. Take the 20 minutes or so that it takes to play the games there. After each game, you get an indication of your score in various sort of key behavioral biases. And you get a short report on the app as to what that means and how it might make you react in different market circumstances. It's fascinating stuff. So again, mitigating risks begins with being aware of them, right? There's likely to be loads more risks that will assail you when investing in retirement than I've mentioned today. But by being alert to them and then considering how to plan your retirement in light of them, really you're at least halfway there towards staying on the right side of those risks. Now, you might be feeling a little overwhelmed by all this talk of planning and risk mitigation and such like, but I've got two things to say about that. Firstly, this is just too important to just say, oh, sack it, I just can't be bothered engaging with that, and leaving the whole thing completely to autopilot. You cannot abdicate control of your finances at this absolutely crucial stage of your life. You can delegate to a competent advisor, but you're still responsible, and you need to be awake to that responsibility and take it seriously. Secondly, behavioral risk mitigation is largely about putting in place frameworks so that your portfolio does the navigating for you and to try and prevent you from making bad decisions at the wrong time. Building a cash flow ladder and resolving not to meddle with it on the back of the bad financial headlines that you read over breakfast, that in itself will get you a long way towards having a financially successful retirement. You can help minimize bad behavior with good financial architecture. Right? If you take one thing away from today's episode, it's that. Yes, there are different risks you need to be aware of, but you can minimize the impact of those risks and the likelihood of them leading to bad behavior on your part by putting in place a good financial architecture. Food for thought. Now, as I mentioned earlier, in the next few weeks, probably late June, maybe early July, I haven't got a firm date yet, we're going to be doing a founders launch of the third and final phase of Meaningful Academy, which is called Retirement Planning, just like this season of the podcast. So the two modules which will be available at launch will firstly be a much deeper dive into some of the things we talked about today. A retirement portfolio, the cash flow ladder, how to review and rebalance it for different market situations. And the second module that will be available at launch will be how to plan your retirement using the amazing Voyant Go cash flow planning app. Now, I've got a couple of hundred people in the academy now using Voyant Go, and they absolutely love it. I get questions all the time on it and comments on how cool it is. Super powerful and yet easy to use. So if you want to be a part of that and you want to be kept informed about when the launch of retirement planning is coming, head over to meaningfulacademy.com and click to find out more about retirement planning. Add your name and email address to the form and we'll keep you posted. By the way, the first two phases, which are financial foundations, which is all about the basics of budgeting, getting out of debt, things like that, personal protection. That's called financial foundations. That's available now. Phase 2, which is about build wealth. It's called Build Wealth, rather. As the name suggests, it's about how to build a portfolio, how to review it, and also includes access to Voyant Go. And there's a whole lot of videos in there on how to use it. When we do the launch, we'll be doing bundle pricing as well. So you can buy Build Wealth and retirement planning together if that's what you fancy doing. So add your email address to the form at meaningfulacademy.com. Click to be kept informed about retirement planning, and we'll do just that. Okay, here is a review headlined, Make This Part of Your Routine, by somebody called Pusey from Spain. Nice to have an overseas review. This podcast really covers so much and every aspect is explained precisely, cutting through all the jargon. It's like having a financial advisor in your ear. Great stuff. Well, thank you very much, Pusey. Really appreciate you taking the time to leave that review from the Spanish version of iTunes. If you want to leave me a review, meaningfulmoney.tv/iTunes if you happen to be listening to this on Apple Podcasts. But if you're on Spotify or Spreaker or wherever you're listening to this, if you can leave me a review or even just a 5-star sort of rating, please do so. It massively, massively helps me out. Okay, next time we're going to be talking about avoiding costly mistakes. In retirement, any mistake you make is likely to be more impactful, more costly, simply because you might not have the time to undo them. You probably don't want to go back to work and earn a whole lot of money that you've lost because of a bad investing decision. So I want to try and help you sidestep those mistakes before they become an issue for you. Okay, that's it for this session of the podcast, folks. Hope you enjoyed it. Hope it was helpful. Questions and comments, go to meaningfulmoney.tv/RP5. That's meaningfulmoney.tv/RP5 for retirement planning, episode 5. Hope you enjoyed it, folks. Thanks for listening. I'll talk to you next time.